We know that the market now moves so quickly with the algorithms actually deciding initially whether or not you should get out or move ahead. It's nerve-wracking. And one of the things that clients have been doing, though, which is very smart, is taking some profit from some of the winners all along and then building up cash for when the market sells up, when volatility kicks in, so that they can then go back in and start building up again. Because they also realize the headlines are so important in this particular market period. Yeah.
Art, to that point, you could be afraid of staying in the market and not getting out because there's going to be a worsening in the relationship. Or you could get out and then be afraid of missing out if all of a sudden you get one headline or one tweet or one comment in one report and things look all of a sudden like they're going the other way.
Yeah, Kelly, I think it's pretty amazing that when we look at the basics of the psychology of what drives markets, it's always fear and greed, right? And it boils down to how much your sentiment changes when prices change. So at the beginning of this year, everybody felt like they missed out. December looked terrible. Everyone was out of the market, and then we were up 25% in 3 months. Over the last 5 weeks, we're down 5%. The market's been off, and everyone's thinking, oh, we have to get out of here. And that's exactly the point in time we're at right now. When you look at the investor surveys and how bearish people are right now, when you look at the fear and greed index and you see how nervous people are, that's probably a good thing on a counterintuitive basis to say, you know what, I hope more people are nervous in this market because that's going to point to a...
How worried are both of you about an economic slowdown?
That's becoming increasingly a concern. I think that's part of what the Treasury market was indicating, because you're starting to see some of the data here in the U.S. slowing, not stalling, but slowing. And the worry is that the China situation exacerbates the slowdown if they don't start having a stabilization and a growth in China. But the data clearly have been slowing, and we need to see unequivocally strong data to get this market, underpin this market for investors to come back. There are pockets of the market which are fine, China or no China. The market can actually do well. It'll just reclassify, reallocate. But we need to see that data turning around. It's weakening.
Art?
Yeah, I think Quincy's right. I think there's obviously a balance of good and bad data that we've seen over the month of April and into May. But I think that everything's predicated on how long it takes for us to be in a mutually destructive trade war with China. Right? If that were to resolve itself somehow in the front half of this year or over the course of this summer, I think there'd be less manifestation of bad economic data going forward. We're kind of stuck in it. It's not all natural business cycle that is slowing things down. A lot of it has to do with the fact that, hey, I'm a business and I've got a great deal of uncertainty over my complex supply chain. I'm not going to make a lot of investment unless and until I know where I stand on trade with China.